Hello and welcome to my channel, Borisnomics. I'm Boris, I'm an economist, and I'm making videos here explaining economic news and what it means to you. Today, we're going to hit a big topic, the interest rate, and why it has become so low and what it means to you. So, let's go! This graph shows the Bank of England base rate since 1975. It averaged around 10% before the 90s and then 5-6% through to 2008. Come March 09, something spectacular happened. To help the economy recover, the Bank of England, along other central banks, cut interest rates to the lowest level we've ever seen until now. As the global economy came out of the recession following 2008, central banks were messaging their plans to start bringing the cost of borrowing up again. The US started tapering, a term for buying less bonds. The UK adopted forward guidance, signalling not to increase rate until unemployment was lower than 7%. And then, of course, the Brexit vote happened. And this Bank of England cut rate again before we saw evidence that the stock market didn't suffer as anticipated, back to 0.75%. But now it's a different type of crisis. The economy didn't just suffer. Almost everything that you cannot do at home has stopped. The UK has drastically cut the bank rate back down to 0.25% in March 20 and further to 0.1%, a historic low in more than 3 centuries. The interest rates that central banks set are hugely important for everyone. It sets the interest you pay if you borrow to buy a home, to name one impact. Now check out my other video on what it means if you're planning to buy a property in the future. So, what does it all mean? What's the central bank's motive? It's all because of the global coronavirus pandemic that's causing a huge drop in consumer confidence. Because of that, a huge decrease in the demand for so many products and services. And that's doing two things really. First, companies are finding it harder to meet their financial obligations, and what this interest rate cut is doing is to make it cheaper for them to pay their loans. And second, you're not really earning anything by saving these days, so what's the point of saving? Some would argue. You might as well spend the money or invest in other assets such as stocks, and hopefully that would push the asset prices back up to where they were. But as we saw in the last weeks, really the financial markets have been really volatile, and since the beginning of this year, the global markets dropped by about a third. So has it worked? Not sure. What's more, a lot of people are losing their jobs, income, because of this, and they're struggling to pay rent or mortgages. So why would they want to spend more at this time? And this is a really valid question. Now, it's important to recognize that this is not just an interest rate cut, but also an asset purchase program, or what is used to be called quantitative easing around the world. And what this is doing is central banks printing money out of thin air. It's just a number that they create, and then they use this money that they create to buy government bonds from companies and funds. And because of this increase in demand for the government bonds, asset prices go up. And because also these companies have more money now to buy other assets, the return on other assets also decreases, and prices go up. So that's the theory of how it would help kickstart an economy when it's tanking. Whenever we talk about interest rate, it's always important to remember inflation and exchange rate. When you're injecting money into the economy, you're essentially having more money chasing after the same amount of goods and services, and the general price level will increase, and that's inflation. But also, you might be wanting to save your money in another currency if your interest rate has dropped, and presumably you're earning more interest in another currency, and that is causing to an extent, exchange rate movements. But as we have seen in the past couple of weeks, that's not telling the whole stories. A lot of money is moving to the US just because the United States is seen as a safe haven in times like this, when there's a lot of uncertainty in the markets. Has it worked? Let's do a summary here. Central banks have announced drastic monetary policy measures to try and mitigate the economic emergency because of the virus situation. If 2008 is anything to go by, yes, it could work. It has worked before to an extent. Asset prices are now higher than they were 10 years ago. But monetary policy has its limit, and if this whole thing is going to work, it will require fiscal stimulus as well. And we've seen that in the United States already, where there are tax breaks, and in the UK, the state is even paying 80% of people's wages where they've lost their jobs because of the closure of pubs, restaurants, theatres and cinemas. Now, check out my other video on this fiscal package and why it works. Thank you so much for watching this video. If you like it, please like it. If you don't like it, still like it. And comment and subscribe to my channel Borisnomics. And I will see you in the next video. Bye.